Hi, my name is Manuel. I'm here with Bana, Andrea, and Michelle, and we are now going to proceed to the presentation of Danone. Danone operates in the food and beverage industry all over the world. Their three largest markets are in the USA, France, and China respectively. The company operates through four segments: EDP Norum, which is the section of fresh dairy products and plant-based products in USA, Canada, accounting for 29% of Danone operations. The largest operations are in EDP International, which is related to the rest of the world operation. Next, we have the specialized nutrition, which is the section of advanced medical nutrition and early life nutrition. Lastly, we have the water section. Their well-known brands consist of Activia, Evian, and Volvic. Now, moving on to historicals, as you can see on the slide, the last 3 years show consistent accounting lines in terms of COGS representing around 50% of net sales, and OPEX representing 30 to 35% yearly. Despite issuing greater debt last year, their debt-to-equity ratio has fallen, indicating a rising market cap. This is likely a result of rising profit as indicated on the chart to bottom left.
As we can see in this slide's graph, we expect Danone's growth to be pretty consistent for a forecasted period. Also, Evian, Activia and White Wave are the products that most contribute to sales. Now, I will explain our assumptions behind Danone's growth. The EDP Norum segment, with the acquisition of White Wave, a major player in the growing plant-based market in which Danone is trying to improve its positioning, is expected to grow at 9 to 10% in the first fiscal year after White Wave's integration. This is also taking into consideration the negative impact of possible international trade disputes since Danone imports many commodities such as soy. Afterwards, the growth rate is expected to converge to an estimate of the growth of the global yogurt market. Regarding the EDP rest of the world, Danone is expanding into food and drinks markets, and the brand Activia has made a recovery due to marketing activities. The segment is expected to grow at 5% for the next 2 to 3 years, even though there is currently a boycott in Morocco. Since the long-term international demand is expected to fall because of rising intolerances, the growth is expected to temper down to 3.5 to 4% after those initial years. About the water segment, the global bottled water market continues to grow at 7.4%, with Danone being number 2 in market share size. Evian is one of the largest contributors, but the largest growth comes from Mizone, a vitamin-based water. And even though the market reports 48% of customers are changing from sugary drinks to flavored water, we expect a growth of 5 to 6% for the forecasted period, as the prices for bottled water have been rising and there is also a growing environmental concern about plastic. For the specialized nutrition segment, we expect a growth of 4.5% by the end of this year. The growth of the aging population and fertility rates are increasing, and there has been a higher demand for specialized products such as lactose-free or allergy-friendly products. However, it is expected to converge 2% in the long term as Asian markets are proving difficult for Danone to penetrate.
Now, regarding our cost of capital, for the free risk rates we use France and USA 10 years bond. As the USA market is twice as large as the French market, we compute the weighted average of the two. Regarding the tax rate, we took the average of the reported tax of our peer groups, about 31.55%. Regarding the market premium, we just used the global average of the market premiums, 5.5%. Also, we want to highlight that we calculated the cost of equity using the market value of the equity. For the cost of debt, we use the bonds Danone has outstanding with 7 years, which offer a yield to maturity of 0.9%. Now, looking to our peers, we select our peers based on 3 main parameters: geographic distribution, business sector operation, and profitability. Also, we analyze our peers' prospects through the comparisons of EBITDA margins to ensure that they were in conformity with Danone, because we believe this is crucial to reach out a good valuation.
To determine the equity value of the firm, we projected our free cash flows until our terminal year of 2023. Then we grew our final year at a growth rate of 1.9%, discounted all our cash flows at 5.31%, and found our final enterprise value to be roughly 70 billion euros. From there, we netted debt, added OAL, and subtracted minority interest. Finally, we determined our implied share price to be worth 77.35 euros a share from our DCF. Because our DCF model is only as strong as our inputs, we ran a sensitivity analysis first at various growth and WACC scenarios. The figures in green represent optimistic growth in WACCs. We also tested the sensitivity of variables we found to have had the largest impact on the valuation, including sales growth rate, the operating ratio, the beta, and the market premium. Consequently, when we adjusted our beta or market premium by 0.5, that was found to have had the most significant impact on the final equity value, indicating that the WACC and its inputs are among the most integral to a valuation.
As before mentioned, we choose General Mills, Kellogg, Kraft Heinz, Mondelez, and Nestle as our peer group. All of these companies are active in the food processing sector and are comparable in terms of operating markets, margins, and cost structure. One of our selections criteria was a comparable product portfolio in terms of dairy products and snacks, as Danone offers. More importantly, we try to find peers that derives most of their revenues in the US and Europe, as Danone is doing. As multiples, we choose EV sales, EV EBITDA, EV EBIT, and price per earnings ratios. As the sales figures differ quite a lot among our peers, and depreciation and amortization has a significant impact on Danone's net income, we decided to only take the EV EBIT multiple as well as the PE multiple into the account. The football field below shows the results of the different valuation methods. The implied share prices vary between a range of 66 to 77 euros. And this leads us to a share price of 74.17 euro. This price is based on a 60 to 40 DCF to multiple widening. The reasoning behind this is, when a company valued has a diversified revenue source, the free cash flow method can be a better approach than the comparable method, simply because finding a true comparison can be problematic. As Danone derives its revenue from the segments EDP, nutrition and water, it makes it quite challenging to find a significant peer group. Because of the price as of December 7th is at 63.80 euro, we are referring to a strong buy recommendation till it hits the target price of about 74 euro. Thank you very much for your attention. We hope that you liked our presentation on Danone.